Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and/or financial topics. So we're going to dive right in, take a look, see what people are sharing. If you want to follow me, it's at Finance. And if you want to join our community, finding-value.com, where I dive deeper into all this stuff, looking for potential investment opportunities. You can also track along and learn what I am doing, the strategies I'm deploying, position sizing, all of those things. Mayday coupon code is still active and you can use that. So Sahara SPPP, which is the Sprott Platinum and Palladium Trust. The sideways range off the lower parallels. So what we've got here is we've got these uh, upward sloping channels. We went into a falling wedge, a double bottom, and we're breaking out of that double bottom for SPPP. That's palladium and platinum. We're starting to head higher, and this will also correlate to some of those platinum group metal mining companies, which we nailed the bottom on. So good job if you guys are still holding. The energy realist. I don't think this should be anyone's base case, but noteworthy call from S&P on the possibility of $15 US gas a year from now. They're talking about natural gas, not gasoline. Meanwhile, P10 just commented their frac horsepower shrank 10% this year as they retire tier 2 assets. So global LNG and gas price outlook in 2026, US Henry Hub price spike expected in the winter of 2025-2026. That's in 1 year. And they think that we're going to get a price spike. So let me read this real quick. I'm going to read these bullets here. It says feed gas requirements for US LNG exports are projected to increase by 6 to 7 billion cubic feet per day, 55%, between quarter 4 of 2024 and quarter 1 of 2026. In line with new liquefaction capacity coming online, production growth is expected to lag behind this demand surge due to a combination of low forward curve price signals and greater capital discipline. In addition, shrinking gas coal switching capacity as the coal-fired generating fleet retires has removed a key balancing mechanism for the market. As a result, we forecast US storage inventories to move into a deep deficit to the 5-year average in winter of 2025 and 2026, which is 1 year from now, leading to a dramatic price spike. In February and March of 2026, US Henry Hub prices are forecast to average just over $15 MMBTU, although there is a lot of uncertainty over exactly what price will be needed to balance the market. So that is the setup there. We've got all this demand coming. It's a lot of liquefied natural gas demand from these terminals coming. And we could see a big price spike. Now, what happens if we get a really cold winter in the world in general and all of this comes online? Guys, this is a huge opportunity. And some of these natural gas companies are not very expensive right now. I can I can let you guys know the exact companies that I am playing this with for this potential setup that we just went through. I've got a couple off the top of my head that will do fantastic. Moving on down. So an athlete won't judge you for working out. A millionaire won't judge you for starting a business. A musician won't judge you for trying to sing a song. It's always the people going nowhere who have something to say. Unknown quote. Anastra says the US government is behind Tether. One branch of the government is investigating the other. They are going to use this story to collapse Bitcoin and then scam pump it back up when the investigation is done and cleared. Bitcoin is a liquidity trap and they have reached the limit, in his opinion. I have no idea what's going on with Bitcoin and Tether. All I'm going to say is there's some people with some strong opinions out there. Some people think that Tether is completely corrupt. and that they actually don't have the backing that it says it has. But we'll see. I don't have any skin in this game. I just read what people are writing here. Regional banks are the first to let go. Banking crisis 2.0 soon. We can see banks are down today. I wouldn't say this is a banking crisis. I mean, if they were all down, like New York Community Bank Corp being down 9.65%, now that could be a problem. But being down 1% or two, not necessarily a huge problem, at least not yet. Happy rig count Friday. We've got oil down 2 rigs and gas is up 2 rigs. So basically a wash on the rig count. I do think we're bottoming. We've been shedding a rig, rig here and there. But if we do have this type of squeeze in natural gas coming, this guy here, oh my goodness, I've got such good investments for the taking advantage. The rig count's a way to play natural gas. And there are some drillers out there that are uber leveraged to the price move of natural gas and oil. Rigs are impacted by both natural gas and oil price. So if we get into a condition over the next couple of years where we have oil prices and natural gas prices going up, you're going to get a squeeze on the rigs, and you're going to have to increase rig count. When you increase rig count, that's going to be incredibly good for all of the energy service companies. I think depending on how much they can get out of some of these shales and all that stuff, I think playing the energy service companies, I think is a great way to play it. They are incredibly cheap compared to everything in the market right now. So we got that going. The gold to silver ratio is about to confirm the bull market in the precious metals sector. When silver starts to outperform, that will be the case. The ratio could fall from 80 towards 30, and anyone familiar with the longer time frame of this chart knows that it can happen very quickly. For example, if we assume $3,000 gold, silver would be about $100 an ounce if we get that 30-to-1 ratio. So we're squeezing up here. We did have a big selling pressure move lower there. We've been struggling to go back up, so that does look like it wants to head lower, in my opinion. Where silver will outperform gold. Despite the latest dollar rally, emerging market currencies are still stronger than any time in history. And this is the Emerging Markets MSCI Currency Index. I think it's actually going to go up. I think the dollar is going to go down. We can see that set up in the Canadian USD. We can see it in the BRL USD, and we can see it already breaking out in Australian dollar versus the USD, and also the British pound versus the United States dollar. Those are already all breaking to the upside. And if you draw a trend line across here, you draw one just straight through here, you're going to see that we're about to, this is a breakout retest, and we're probably going to start running higher here. What is the ramifications of that? Why does that matter? Well, it matters big because money flows change when a currency outperforms another currency. Recently, we've noticed that the stock markets in the United States have done very well. We've also had a strong dollar. And when that changes, when we get strong Canadian dollar and other currencies, you're going to see emerging markets rip. We saw that back in 2002 at the bottom, and then they ripped all the way to 2008. It's no, there's no, how can I say it? The correlation here between currency strength and those markets ripping is all rooted in currencies. And with this strength here, you're going to see money flow into emerging markets. And I think we're breaking out right now this big long-term consolidation from 2010, 2011. That consolidation is breaking to the upside, and I think we're going to see a big move in emerging markets. So again, we are playing this breakout here. There's a ton of things. And when the dollar drops, you're going to see commodities go up, precious metals go up in emerging markets. They're all going to go up when that dollar drops. They're buying gold, the biggest inflow since July 2020. Look at the inflow coming into gold. This is the biggest inflow to gold funds, flows to gold funds, and you can see the big move, and that also occurred in 2020. Silver, the physical silver demand is going to break $35 silver, that resistance. And this is 707 million ounces naked short that's going to get absolutely smoked by this water out here that's going to flood them. That's the physical silver demand. And speaking of physical silver demand, I've got this right behind it. There's 100 million troy ounce or more physical silver supply deficit, excluding investment demand. They cannot magically make physical silver appear out of thin air. This is your deficit here. So silver mining consumption, we've got millions of ounces in your time frame. In 2022, silver consumption exceeded mine supply for the first time. Whenever this occurs, you start to run deficits. When you start running deficits, you start eating through inventory levels. When inventory levels get to critical levels, what occurs? The price goes vertical. So what he has here is silver consumption is set to grow rapidly thanks to electrical and photovoltaic usage. Total mine supply is looking like it's projected to go lower, and we have total silver demand, excluding the physical investment, to continue higher, and this gap is blowing out. You know what that's a recipe for? Very, very high silver prices. And you know what can't react very quickly? Building mines. So we could go vertical goose on the silver price. This is what could drive that big cup and handle a 45-year pattern. And you know what they don't want? They don't want the silver price to go vertical because guess what happens? A bunch of retail investors start to pile on the physical demand for investment. And the investment, excluding investment demand, isn't even in this calculation. So this could be way higher if investors jump on this and they start to see the price move. And there's a lot of retail. I mean, guys, they just buy whatever works. They just buy what's going up. If silver starts going vertical, I think the retail sector is going to get involved. Not saying that's good, right, wrong, or indifferent. It's not good or bad. I don't really care. They're going to come. They're going to squeeze the living crap out of this thing. Copper's looking extremely explosive. It has a very similar pattern to oil. Shoulder, head, and a shoulder with the neckline up here. So we're probably going to see a big move out of this. It's right at the bottom of the shoulder. That's where a lot of iron ore companies are at. That's where a lot of oil companies are at and service. They're all doing the same thing. We're about to rip here at some point. It'll probably come after gold and silver do their thing. They'll rip, and then we'll start to see oil rip and copper rip. Everything will come. Here's something you don't see every day. 5 U.S. banks face billions in losses as silver price spike hits short sellers hard, says the report. And I wonder what that's going to do to the banks. I really wonder what that's going to do. They could be eaten here, guys. And if we get a big move, I mean, these deficits in silver are going to push the price higher. And if the investors jump on this, I mean, I don't know what these banks are thinking, man. They're screwed. If they are screwed, they can't unwind it. If you unwind here's the problem, guys. The paper market is so much bigger than the physical market. If people start to figure out that there's a problem, I think people are just going to pile on. They're going to pile on like mad. The problem is they can't cover the shorts because then they become buyers themselves. So now there's no short sellers and everyone becomes a buyer. And I heard people say, well, they'll just cover it. I'm like, you can't cover the losses. These guys have 0% reserve requirements. They don't have crap for cash. They are screwed. They are screwed. Well, I guess we're gonna have more bailouts in the future, right? Liquidity is coming on the RRP dropping to new cycle lows also soon, leading the Fed to end QT faster than otherwise telegraphed. This is liquidity inflows seen lately as outflows from on RRP intensifies. I don't even know what RRP facility is. That's the reverse repo, I think. Reverse repo, whatever it is. But it's coming on down and looks like we're at a low here, that reverse repo. Reverse repo purchase agreements. There we go. The flag is setting the stage and building the fuel for the ballistic phase to launch. I think it will be game on next week. And what he's talking about is silver. We've got the flag pattern, the flag and silver setting the stage to launch the ballistic phase of silver. Here we go. Silver barely gave the skeptics a chance to get on board. And you can see we've broken through the resistance, doing a little bit of a flag pattern and a retest of that breakout. This is rip of the 10-day moving average. Okay, I got it. Ripping off the 10-day moving average. We are now long SPPPP. I'm starting to be a real believer in PGMs. Will be a mega trend like no one is really imagining right now. I'm sure lots of ramps and drops along the way, though. Good luck to all my precious metals or platinum group metal bulls. Let's ride. I've been riding this train since 2019, guys. I bought the crap out of it. Bottom of 2020, platinum. Palladium looks good here too. Everything looks good. We're playing the platinum group metal mining companies in the community on the website. We're locked and loaded for this. We are locked and loaded. Allow me to introduce myself. Hello, I'm Mr. Slammy, always at me. I wake up weekdays at 8:30 a.m. Eastern Standard Time with only one thing in mind: slamming the crap out of gold and silver, the most overrated and disgusting metals on earth. And this is silver being slammed in 3 of the last 4 trading sessions, and it's always in the morning New York time. Guys, get used to it. They've been doing this for like years. Slam, slam. It's always at the same time. And they have huge volumes and they do it like right when things open. They want to kill the sentiment to slow the move down. They don't want silver going to $300 or $200 in a heartbeat. They want to slow the move there. They want it to be controlled. They don't want anybody to panic buy into it, which people will anyway. Nickel trend will continue. FYI, there's the trend line, and we're right at that trend line. We'll see if we can bottom here. Or nickel. Rowney says, nice one by Gavelkal, suggesting that Powell could share the same fate as Burns. So here's the CPI 2010 to 2024, sideways action, big move up, coming on down. And this is very similar to the recession that we went through from 72, 74, and then we had a big move up. Now here, there is differences in this setup here. This setup here, they raised rates and all that. They overbuilt in the housing market, and then it came back down. And then we went into another boom phase because the demographic grows in this time frame. We actually had the demographic go up and down, up, down, up, down, up, down, and we had the home builds go up and down with it. So we actually went into a hyper supply phase here, 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 and here, even though this is over in 80, 81. So the real estate market drove all that. And it was the monetary expansion from real estate banking loans that caused that inflation. Today, we've got a lot of fiscal spending. It's a different setup. We've got the 40s mixed in with not as bad as the 70s, but there is a little bit of that monetary credit expansion that is threatening credit creation and or money expansion. Both of those in the background exist, fiscal and monetary. Just noting China liquidity is ripping it here. Lots of liquidity coming into the market, buying up shares, doing whatever. I also think that we're going to probably see a bottom in some of these commodities because China is a big driver of demand. China's housing market has been almost completely demolished. That's why they're doing all this liquidity here. Newly built homes in prices in China fell 6.1% in September, the most in 9 years. Secondhand house prices plummeted 9%, the largest drop in at least 13 years, and fell in all 70 major cities. Absolute destruction. This is what a deflation looks like. This is where it comes from. This is where the big problems are. And it's the demographic falling off a cliff. That's what's causing it, of home buying years. Not people being born. We're talking about people that are of home buying age, and it's dropping. So they can't stop the move. There's nothing that can stop it. It's like, hey, we're going to sell these homes to no one. No one's out there to buy them. There's a lot less demographic. Silver alert from Bob Coleman. The CME will be raising margin requirements by 4.3% on silver futures, effective after October 25th, 2024. This could also be why we're seeing silver go down. Now, they did this a lot last silver bull market. They just kept raising the margin requirements, slowing the price of silver down. This is one of the tricks up their sleeve that the COMEX uses to slow down the price move. I mean, just an FYI for everybody. Callum Thomas, go big or go bigger. New paradigm likers will enjoy this chart. The bear case is obviously that tech is too big and too concentrated and represents excessive valuations and giddy sentiment. The bull case may be as simple as tech is the new transports. So finance and real estate dominated the markets in the 1800s, early 1800s, mid to late 1800s. Then we went to energy and materials from early, 1913 or whatever, all the way to, I'd say late 1990 or so. And that's shifted into information technology and communication. Looks like finance and real estate was in there for a little bit. But information technology communication has been the share of the largest sector in the US for, I'd say, a good 30, 40 years. On down, could there be an unexpected slump for housing starts in 2025? So this is building permits minus completions. You can see that we are coming lower. Could we head lower in housing starts? We very well could. If interest rates continue higher, I do think it's going to weigh on housing starts. And if housing starts go below this zero, that is when we get recessions. Period. Bar none. We get recessions. So we're coming on back. We're at that zero level. We'll have to watch and see if it continues lower. If it continues lower, that is when they generally pull back on construction employment. When you pull back on construction employment, that's where you get that unemployment spike. And that's what we can watch. Yield curve, unemployment spike, and housing start. Those are the driving factors. And that's where we're going to end it, guys. That's all I've got for today. So give me a thumb up for the content, subscribe to the channel, subscribe to the website. Mayday coupon code is still active. And that's all I've got for today. We'll catch you next time. This is Finding Value.